If you guys are here to learn how to buy stocks cheaper than everyone else, you're in the right place. That's what we're getting into today with selling put options. This is the outline. I'm not going to go through it all. Pause the video and look at it if you want to see it. Let's dive right into this stuff and get into the good strategy of naked puts. They are stock option contracts where the buyer pays for the right, but not the obligation, which is the key point there, to sell 100 shares to the seller of the contract, but only if the specified price of the strike price and the date are in play. And what I mean by that, you'll see in a second. The seller gets paid for taking on the risk of having to be assigned or having to buy shares of stock at a specific strike price at a specific expiry date. That is a naked put. This is an example right here. Rob, our man Robbie's selling a naked put contract on Tesla because he loves Elon Musk. He thinks he's a new Iron Man. He wants to get paid some premium. So here's what he does. He goes and sends Tesla's shares price at 195. Okay, boom. He wants to go below that because naked puts, when you sell them out of the money or lower than the current stock price, you get paid a little bit better premium and take on a little bit less risk. Okay, so you're going boom, 180 for the strike price. It's $15 lower than the current price of Tesla. Expiration date is March 31st, 30-ish days away. And the premium that Robbie Boy is going to get paid here is a nice, cool 845. So he gets paid 845 to potentially having to buy 100 shares of Tesla on or before March 31st, 2023. And this only happens to Rob if the share price of Tesla goes below 180, which is a $15 decrease from where it's currently at. So there's two results from this trade. Okay, there's two ways this could go. Number one, Tesla share price increases, stays the same, or decreases all the way down to 180.01. Robbie Boy gets to keep his 845, no questions asked, doesn't buy any shares, free to repeat the transaction again over and over again. The contract keeps expiring worthless. Option number two, though, if the share price of Tesla does decrease below that 180 threshold, that strike price, Robbie has to buy the shares, but also gets to keep the 845. So it's still a win-win for him. He gets to buy the shares for 18 grand, which is again a discount from the 195 it's currently trading at. So the benefits here wrapped up. You can create a passive income stream with naked puts, and you can actually know your return on investment or your potential return if you get assigned shares before making any singular trade. You get to know that up front, what you're going to get paid to do this, which is a huge advantage. There's no guesswork on how much money you're going to make. You can recycle your capital by when the contract expires, you can go and sell another one and another one and another one and another one and just keep the wheel kind of moving. And worst case scenario in this scenario is that you get to buy shares as you want at a discount. And I'll show you how to calculate that in a couple slides here. So stay tuned to that. Now, some risks. There's definitely risks to naked puts as well. Don't let me tell you that they're not risky. They are, if you don't understand what they are doing, but they are a less risky kind of move. There's risk in anything, right? Any stock, any index fund, any ETF, anything could go to zero in the stock market. So all you're doing is agreeing to potentially buy those things. If you went and bought them anyway, they could potentially go to zero. You're potentially limiting your upside when you're selling naked puts, because if you just bought the shares outright and the stock price appreciated, you'd be missing out on those gains, but you'd still be capturing the premium that you agreed to get paid when you sold the contract. Sometimes people get greedy when you sell naked puts. They sell them on crappy stocks because they get paid more premium and they get more money in their account, but the stock is actually shit that they're selling them on, which is not what you want to be doing here. You want to sell on quality companies only. And they use margin sometimes. If you use margin or borrowed funds from your broker, you are amplifying your returns potentially, but also amplifying your risk and setting yourself up for potential margin call if the market moves against you, which can wipe out your account in a matter of minutes, literal minutes. So how do we buy naked, or how do we use naked puts to buy stocks cheaper than everyone else? This is a huge concept you have to understand right now. Right in our example with Robbie Boy, current Tesla share price 195, naked put price 180. Okay, $15 difference there. Expiration date, premium 845. So again, if Rob has to buy 100 shares of Tesla, okay, we're talking about buying shares cheaper than everyone else. This is how we get. This is how we calculate it. This is how we get to it. It is a massive discount that he gets because he sold naked put instead of buying shares outright. Here we go. If he was just to buy the shares on the open market at the time of selling the put, it's going to cost him 195 per share times 100, because there's 100 shares in every options contract, 19.5. That's Rob's cost at present time. If he sells naked put at 180, okay, if he has to buy the shares, he does it so at 180 per share, 18,000. So right off the hop, okay, if he sells the naked put and ends up getting assigned shares, there's an opportunity value in the future that Rob's going to be able to realize. It's not in his account yet, but it's because he's buying it $180 per share versus 195. So the difference there is $15 per share. That is saying that in the future, Rob has the opportunity for the stock to go back up to 195. So there's an opportunity value that he might get to capture in the future if Tesla goes back to where it was previously. Okay. The premium he earned is how he actually gets some discount on the stock that he bought. He bought it at 18,000. He got paid 845. So he purchased the stock all in for 17,155. Again, if he would have bought at the open market, 19.5. He buys it now after the contract actually gets exercised within those 30 days, 17,155. He is going to get a $22,345 discount for using the naked put to sell and then actually get assigned the shares versus buying outright on the open market. That's how the math works on buying stocks cheaper than everyone else. If you get assigned with naked puts, it's actually a huge advantage, but only if you sell it on good quality companies. So when do you want to sell naked puts? You want to do this when the market is projected to move higher or remain neutral. You want to do it around earnings announcements. You want to have any kind of company special days like we talked about in the covered call video. You want to have extra volatility in your premium that you're getting paid. And when you actually want to buy shares of stock, you can go ahead and sell covered calls near or at the money and potentially get paid. Like in our example here, if you want to buy them, you just make this 180 go up to like 190. There's a higher chance of you having to buy the shares. You're going to pay a little bit more premium, but you're still going to get the stock at a discount compared to the relative price today. When not to sell a naked put, when the price of the stock market or the stock you're selling it on is projected to move lower, you don't want to do that. You want to stay out of the game and wait. When the volatility is super low, there's nothing going on, you're not getting paid enough risk reward, you're not getting paid enough to take on the risk of buying shares, you do not want to go ahead and sell naked puts at that time. You want to be very careful and cautious, especially if volatility picks up. And that usually coincides with the market sell-off. You don't want to potentially own shares. You don't want to sell naked put, because when you sell naked put, again, you are taking on the responsibility or the obligation to potentially have to buy shares of stock. How to do this for a weekly income? You want to target companies with an average daily volume over 1 million, because if you don't do that, there won't be enough volume to actually get your positions filled at a respectable price. And there probably won't be enough premium for you to generate a consistent income stream that is acceptable in terms of risk reward. You want to determine those targets before you sell the contract as well, and know what your profit's going to be and what your profit targets are every time you sell that weekly put option. And then you just sell a naked put contract with weekly expirations, and then just repeat week after week after week. If assigned to shares, if you do get a kind of a drop in the market and you're assigned shares, sell covered calls and continue making money. To learn how to do that, check out this video right here. Moving on, when to sell for naked put for monthly income. It's the same as weekly, but you're going to change your expiration dates from weekly to monthly, obviously. So the timeline is different. You're going to have to understand volatility a little bit more and its impact on your potential profit, because the volatility week to week is going to be different over the course of a month. So understand the best times and those targets throughout the month for when you sell, and picking your strike dates and your strike price and your expiration dates really matter with the month. It might be 3 weeks, it might be 5 weeks, it might be 4 weeks, but you have to understand volatility and the impact that it plays. And using chart indicators becomes more important on a weekly or on a monthly versus weekly kind of basis. You want to try to use technical analysis to help guide your strike price selection on selling those naked puts when you're looking at monthly income. The biggest mistake that I see people make when you're selling naked puts is that you need to always sell naked puts on stocks you actually want to own. People get into trouble. If you don't want to own the shares, don't sell naked put in the company, because you can get stuck at some time owning shares of a company that is dog shit that you don't want, that you're going to look at your portfolio and say, crap, I don't want this in there. I don't like it. I don't want to have it. You're going to do something stupid like sell it and lose the money. So if you don't like the stock, if the shares suck, if the premium's like juiced up because it's crazy volatile, but the stock is actually dog shit, do not sell the naked put contract on it. Sell it only on stocks you actually want to own. And if you guys want to see the example that I showed you about Robbie Boy and his Tesla put, I'll show you how to do that inside Interactive Brokers right now.